Okay, hey, trust you were doing well and having a great week this week. Wanted to just shoot a quick kind of update on some of the things that we're focused on and talking on here in the marketplace and kind of give you an update on what we're seeing. Clearly a lot of information and news going on surrounding the stock market, the economy, kind of sell off in the tech sector with some of those things that are taking place. Also, information coming out about the stickiness of inflation, and then the question of the Fed being divided, whether they'll cut rates or not cut rates for next month. And so just a lot of that going on. But again, really want to focus on what we see happening in the distressed area of commercial real estate. And again, as I've shared before, that's been a truthful thing that both, high inflation, high insurance costs, interest rates that have just skyrocketed. Also in some areas that I shared with you previously, in areas in Atlanta, they had held back evictions for almost 4.5 years in some counties. I mean, so like that was through just last year. So a lot of these things have produced distress, or, fact that, properties were purchased in 21 or 22 when interest rates were, 4% or less. And then now that interest rate is, 6.5, something along those lines. And so it really is presenting a fact that you've got quite a number of properties that are entering into distress. We're starting to see that. And Blackstone recently just completed another $2 billion purchase of distressed multifamily and commercial loans. And then we also starting to see a lot of what's taking place in the marketplace, starting to get a lot of things that are coming into the market that are either pre-foreclosure or foreclosure. There are deals that are being, hey, they're willing to cut a deal and work with you prior to the lender taking those actions. We're seeing that in Louisiana, Texas, Georgia, not so much in Florida. I know just talking with a guy a couple days ago, there's 2 deals I know that are coming up that are basically going to be sold for the debt. And so, that is starting to take place. So what does that mean? It means that there's, the beginning cusp of opportunity. There still is strong demand for multifamily, meaning the affordable housing crunch that we have gone through in this country and continue to be in. That's not going to be readily resolved. There has been some softness in rents in the most recent term, just with absorption of some of the newer multifamily in various areas of the market, and then also just a seasonality as well. But that being said, there still is a need for, significant quality affordable housing in the majority of the main MSAs. So what does that mean? You've got distressed opportunities that are coming into the marketplace where either they have to sell because of the way of the debt structure and they cannot refinance and extend, or they've extended beyond the ability of what the current loan will allow, and so they have to sell. There's other properties that ultimately could not meet the mortgages, and so they are in foreclosure, and those are deals that are coming out. There's also deals where the bank has taken them back and they're now with a servicer, and those are on the verge of coming to the marketplace. So there's a variety of opportunities that are presenting themselves. Now, that being said, I would also say that not everything that glitters is gold, meaning just because it's a cheap price doesn't mean that it's a great deal. And so that's where it's important to see and look at, what is the characteristics of the neighborhood, the underlying asset, the underlying area, what is the opportunity. And I think, without question, there's going to be opportunities that we'll be able to see and source that come into our pipeline. Will be a great opportunity of execution to be able to be purchased at a low relative value to what the pricing was and is. I mean, there's some transactions that we've seen recently where the current marketplace value would be, call it $100,000 a door, $95,000 a door, that active trades are happening in that figure. And there are deals to be done at 60, 65 a door. So again, if you're buying it at 60 to 65 a door and it's, relative to 100 a door, that's a 30 to 35% discount off of the current pricing. And so that really presents a significant opportunity. There's some that's maybe even priced greater than that I've seen, but also they come with an extreme amount of hair on it. So again, that's where you got to, weigh what the proposition is. So I just share that now because, companies like Blackstone, Apollo, others, they are loaded up with dry powder, meaning capital, and they are beginning to expend that now. Because again, what will take place is a stabilization of those properties over the next 12 to 18 months. Many of those properties they would keep for 3 to 5 years or longer than that, depending on what they bought. With the properties that we would be looking at, a lot of those fall into the category where you can go in, stabilize them, and sell with under 24 months and make a great execution and a great risk-adjusted return because of the basis that it's being bought at. So I look forward to sharing those things as we continue to see the market develop, and I hope that you have a blessed and victorious week, for this is the week God has ordained for you.